rentals. This has been a topic that's come up very frequently, and I think that this is something that it's a bit more unique than most people expect as far as the financing is considered. So I wanted to go over this, go over different techniques and strategies with it, and also go through a couple of items like how it is really like running a business, what the financing looks like, what property challenges you can have, what challenges you might have with the income on the property, what options you would have to finance it, commercial financing, because that is one of the ways of getting these types of deals done, and some of the creative ways that we've been able to get certain deals done on these. Go through a quick comparison of the different approaches that you could be looking at. And then I do want to go through some tips on how to build the empire and some of the things and experiences that I've seen clients do successfully, as well as some of our own units that we've run successfully as well. So, everyone has the dream of buying a vacation property and making a ton of money, and of course, it's not quite as simple as buying a property and just turning on the tap and all of a sudden getting a lot of income in. It is, there's a lot of moving parts. It should be easy, but it is very different. It's a very different business than just purchasing a rental property where you just stick a long-term tenant in the property and you're done. To be frank, you are running a business, and there's a lot of components to this business that you need to be aware of. For instance, generating reviews is a large part of your business here. You are in the hospitality business, and so ensuring that you have timely responses, you're taking care of your guests. You have to remember that an Airbnb or short-term rental, VRBO, etc., you are not compared to a long-term rental property anymore. You are compared to a hotel. So you have to have marketing. You have to make sure that you have smooth check-ins and checkouts. You need to look at having a website so that people can book directly on your website. Furnishing and design, and I'm going to get into that in a little bit near the end of the presentation. But furnishing and design is a really important part of any Airbnb. You have sales. You need to manage cash flow as sales come up and come down, especially if you're in a summer or winter predominant type of market. And again, cash flow management, making sure that you're watching those ups and downs in different markets. The other couple other things you also have to consider is insurance. Insurance for short-term rentals can be very different and can be more difficult. In some cases, we can see that this can be a lot more expensive, and so it's something you do need to make sure that you're aware of and get adequate insurance. If you don't have insurance, this can be a major issue. It's a good thing to note as well that the Airbnb and other platforms do often offer some kind of insurance option as well through their platform. And so it's important for you to understand the different platforms and what type of insurance products are available there. One other item to consider too is that there is some external government policy risk. And so what I mean by that is that in a lot of municipalities, there's a shortage of available rental housing, and that shortage of supply is causing the prices to increase. And there's a lot of pressure at the local municipal government level to minimize short-term rentals. We've seen this in Vancouver. Vancouver now has a policy where they no longer allow short-term rentals. Anything less than 30 days is considered short-term. And so you can still do an Airbnb or VRBO in the city of Vancouver, but it must be more than 30 days in order to be okay. There's also local and neighbor pressures, and in addition to that, not even just local neighbors if you're renting a house, but also if you're in a strata building, for instance, those can be different and difficult. A lot of strata properties or strata buildings do not allow short-term rentals in them, and so that's something you need to be aware of. If you're currently operating that as such, then that is a potential risk for your property. And another issue that may come up is parties and damage. You do need to be aware of the fact that there are things that can come up with the property, and having the right insurance, having the right policies and rules in place to prevent this is definitely a bit of a learning curve. And a lot of the time, people make mistakes in the very beginning. We made a lot of mistakes with our first Airbnb for sure. We had a party, I think the third night that we had our unit up on Airbnb, and we started to learn little tidbits, like, for instance, do not accept locals for one night stays and especially if they appear to be younger or their grammar is poor. And my fiance Christine is crazy about this, but she definitely looks at what is the grammar being used, and there is a correlation between how somebody positions themselves and says, "Hi, I'd like to stay at your place." Okay, well, probably won't be the greatest guest versus somebody that says, "Hello, myself and my fiance are looking to stay at your beautiful unit. It looks great. We're going to do this and this and this in the area." Tell you a bit of a story. In general, those guests tend to be better guests, and so you learn a little bit about little tips and tricks on what tend to be good guests and what tend to be poor guests. And in general, either somebody that's staying local can be riskier, and in addition to that, one night stays are often riskier, and you combine those two together. A local one night stay for us typically is just a no-no. We just don't accept that guest, and we would rather have it empty than have to deal with a party and a massive cleanup. So financing is one of the biggest challenges with short-term rentals for sure, and there's a lot of things to watch out for and look at. So sometimes you'll see a great opportunity, cabin, do it yourself, needs a little bit of TLC, but other than that, it's wonderful. And so this is something that that you'll see sometimes. Certain cabins can be in rough shape, or the type of services that they have, etc. Some cabins may look like this and may look not quite like a normal house, but definitely a lot more suitable for a lender to be considering lending on. So there's a number of different things that you need to look at. On the property challenges for cabins and cottages in particular, square footage can be a challenge. A lot of lenders do have minimums in square footage for detached properties. So if your square footage is less than a certain amount of square feet, this can be a problem. In general, that minimum square feet is about 850 square feet for lenders to give you up to 80% financing on a cabin or a cottage. What utilities you have. So do you have sewer or electricity hookups or water hookups? All of these things contribute to the lender determining whether they will lend to it, or just determining how much they will lend on the property. So some lenders will give you up to 65% financing for what they call a type B property, or up to 80% financing for what they call a type A property. And that often comes down to the square footage and the type of utilities that are available to the unit, in addition to the access. So is it year-round access? Is it road access? Or is it seasonal access only? A boat access only? These are major things that can impact the lendability of a property. The location, this is a very important thing as well. A lot of these properties are in remote areas. In general, even if you're buying a regular residential home in a remote area, it can be a lot more difficult to get financing. A lot of lenders will either not do or will finance a lot less in more remote areas. And so this is something you need to keep in mind. Buying a boat access property in a very small town, or better yet, no town at all, and it's a small unit and there's no utilities or anything like that, can be very, very difficult to finance. One other point that you need to watch out for too is a lot of properties in certain locations may be leasehold. You're going to find this is very common in certain areas, and they may be leasehold. They may not even be prepaid, which means that there's a lease payment every month. So it seems like the property is a really good buy. There's actually a lease that only has 20 years left or 10 years left on it, and it's not prepaid, so you actually have to pay a monthly payment just like you would be paying like a strata fee. The construction type can also make a difference. Some lenders don't lend on log homes, which is very common for cabins and cottages. Just understanding what type of construction type was used is relevant for these types of properties. Any fireplaces do have to have what's called wet certification, and so there's a certain certification that's required on these types of homes to make sure that the home is unlikely to burn down. This is usually more of an insurance requirement, but hey, if you can't get insurance, you often can't get a mortgage, and so this is something that that is often quite relevant when you're investigating a cabin or a cottage. There's also resort properties. These are very common too for short-term rentals. And in general, hotels are no-no. So if there's a concierge, and if you buy a unit in the building, if you must use the concierge to rent and lease out the property and to manage it, this is often viewed as a hotel, and this makes it much more difficult to get financing on. You'll see a lot of these in resort towns, like ski towns, for instance, or summer resorts as well. The title ownership for these types of properties often can be a bit unique too. So you'll see in Worcester a lot. There's a lot of quarter shares, timeshares, co-ops, they call them undivided interest properties. There's a lot of different restrictions on the types of properties that you can get financing on. And in many areas and properties and resorts, there will be bylaws restricting use. And so sometimes you'll be looking at a property that restricts the owner's personal use of the property. And so if you're trying to buy the property, and in some cases, it's easiest to get financing when you're buying this as what's called a second home for yourself to use. But if it restricts the owner use, then it may make things more challenging to get financing on it. Another thing that comes up quite a bit is also rental pools. And so sometimes you would buy a unit and your unit is in a pool, and all of the income and expenses get pooled together and then get distributed out by the property manager or by whoever is managing the rental pool. And in general, lenders don't like lending on properties that are in rental pools because there may be restrictions on the ability to get out of the rental pool. And so in theory, it makes sense because the rental pool just allows you to average out the rents. So that way, if your unit is vacant but another one is not, you're not getting zero, you're just getting slightly less because all of the other units might be rented out. So it balances out the cash flow issue. On the flip side, however, from a bank's perspective, if they have to foreclose on this property and it's in a rental pool, there may be restrictions on the ability to get the property out of the rental pool. And that can make it more challenging for you to get financing because a bank does not want to be restricted in their ability to control the asset in the event of a foreclosure. Other general items that come up on property challenges is strata approval. If it's in a strata building, then you do need to make sure that you have strata approval. In fact, if you're listing your property in Airbnb, they'll often require you to have some kind of proof that the strata has verified and approved you to be able to rent it out in your strata building. City approval may be required. Neighbors can be a challenge sometimes if your neighbors are starting to complain and maybe contacting the city and saying that this person's in violation of the bylaws, et cetera. And so you have to be mindful of your neighbors to make sure that you can run a successful short-term rental. One of the other things that we need to look at here is how a property like this is classified. So here's something to think about, and this helps to understand a little bit about why the lenders have some difficulties with financing these types of units. So which bucket is an Airbnb type of property or short-term rental property put into? Is it more like a long-term regular residential property, or is it more like a hotel? And in fact, a lot of lenders do not lend to what they call unflagged hotels. And so a Super 8 motel or a Westin or something like that, a large brand name hotel that has a franchise backing to it is typically a lot easier to get financing behind. But if it's just a ma and pa hotel, they call them unflagged hotels, and those can be very difficult to finance, or at least you need a larger down payment in order to get financing on them. So these types of properties can be a lot more difficult to get done. So the problem is that most buyers assume, hey, I'm buying a residential property, therefore this should be residential financing. That's not always the case because the use of the property is really more like a commercial venture. You're really operating a business, as we discussed earlier on this property. You're in the hospitality business, and that comes with ups and downs with regards to the income. And so this can be a challenge. And one of the issues that we have is what income do we use at the time of the purchase? If there is no history on the unit and you're purchasing a property now, then that can be a bit of a challenge. Even if the property has been in Airbnb before you purchased it, the bank will still say, well, yeah, but how will you manage the property? And most people that are buying Airbnbs or short-term rentals don't actually have any hospitality business experience at all. They're just buying a property because they think, oh, you know what, I'm a real estate investor. It's getting harder and harder to cash for long-term rentals. So I'm going to look at a short-term rental now, but you don't have any hospitality industry experience. And so the bank looks at you and say, well, why are we going to stick our neck out and lend to you when you don't have any history of managing this property? So one of the challenges we do have is, in general, at the time of purchase, you don't have a lease, you don't have any consistent bank deposits. And even if you go to refinance the property at a later date, if you don't have a lease or consistent bank deposits, that's one of the primary methods that lenders use to look at rental income and how much to use. So it can be very difficult to refinance an existing Airbnb property too, because you don't have the typical required documents in order to fulfill the lender. Now, one other thing that we do find is that many lenders will point to the T1 general. So those are the personal tax returns when you're looking at filing your income taxes. And this number is going to be listed on your tax return. There's something called a statement of rental activities. And the lenders are looking at this to say, okay, what is the rental income? One challenge with this, however, is let's say that you buy a property in the middle of the year, and then you file your taxes next year. When you file those taxes next year and you want to go get a mortgage, the lender's going to say, okay, you don't have a lease, we can't use that. You don't have any consistent bank statements, we can't use that. So how are we going to determine the rental income? Many cases, they'll just say, well, if we can use the T1 generals divided by 12, then we can use that number. The problem is if you bought the property midway through the year and then divide that number by 12, you're having the amount of income used. It gets even worse if you bought the property later in the year. So until you have a full year of T1 generals, it's more difficult in general to get an Airbnb type of property financed. And one of the interesting things about financing short-term rentals is that on the flip side, many lenders will still use the T1 general income, even when in the future it actually becomes a higher number. Because if you think about it, a short-term rental actually has more gross income, more income coming in total, but generally higher expenses than a long-term tenancy does. But the lender is still going to take that total gross income and divide it by 12 to figure out how much rental income they'll use on the property, which is now a bit counterintuitive because now all of a sudden the residential lender is using more income from the property, but only once you have a full year of T1 generals on the property. Now, all this being said, it is generally very difficult to finance the property once it is a vacation rental or short-term rental. And so this is usually, if you're using the T1 generals, this is usually for financing a property, another acquisition down the road, or financing a different separate property, not the one that is the short-term rental. It's very difficult to refinance a property that is being operated as a short-term rental. Most residential lenders will not touch these types of properties and instead push it to other departments like small business or commercial lending. So it can be difficult to get financing on these units, but have no fear. The Green Mortgage team is here. We're always looking at finding solutions. So how do we finance these types of properties? There's three primary strategies that we typically find that is the general method to finance these. And so first of all, a second home is one of the ways to look at this. So if you're going to be using this for personal use, it is usually easier to finance the resort style properties if you're doing it this way. But keep in mind, it is hard to finance these. You're basically removing the property related issues, or not completely removing them, but lowering them. But in the flip side, you're increasing the debt servicing requirement challenge because now there's no rental income being used to qualify for it if you're going to be using it for personal use as a second home. So easier on the property generally, but now it's more difficult on the personal debt servicing and the qualifications. Now, next one is doing this as a rental property. A few lenders will look at this and use what's called the market rents. The market rents is based off of it being unfurnished and basing it off of a 1-year term lease. So some property types may not qualify as a rental. If you're buying a cabin in the middle of the woods, who's going to live there for an entire year at a time? That's not feasible or possible. And so many properties will not qualify to be classified as a rental property. Sometimes for rental properties, you could do this as a net worth, or there are some special self-employed programs that can help alleviate some of these challenges with both second homes and rental properties. But one of the more creative ways that we've been doing these is through small business or commercial. And so these small business lenders and commercial lenders will base the income and the qualifications based off of the actual short-term rental income of the property, but they do require a 2 to 3 year history with you as the manager. And so you can often reposition the property and refinance it after owning it for a couple of years. And one nice thing is if you're buying this in a company name, these mortgages don't report in your credit bureau. They're not interfering with future residential lending applications, as most lenders will say, well, if it's a commercial property and commercial loan that you have, you still need to disclose it and report it to us. But in general, they remove it from the debt servicing because it is a business. And that's, again, coming back to the same thing, which is that the lenders view these types of properties as more of a business as opposed to a long-term rental property. So one of the things that lenders look at is what's called the DCR, debt coverage ratio. And so on the small business and commercial side, they want to see that the income is about 1.25 times the expenses. And so if the operating expenses of your property are about $50,000 and you're bringing in $125,000 a year, then they would lend to an amount where your mortgage payments do not exceed $50,000. So they're always reverse engineering what's the maximum amount of debt that you can obtain on this property. That's based off of a function of how much income the property generates and what the current expenses are. Now, on the debt servicing side of things with commercial, they look at both the rental income, but also something called the corporate guarantee. And so if you look at the rental income in general, small business and commercial lenders look at preferring leases. Sometimes they can use market rents. There's a very small handful of small business lenders that we have access to that will deal with using market rents as opposed to needing to use the actual 2 or 3 year history. It generally does not give you enough financing because normally you wouldn't be buying these types of assets, and they're not usually great cash flow properties if you're buying them as long-term tenancies. However, this is one method of being able to get reasonable financing at reasonable cost by going with the traditional small business lender, where they can give you financing based off of the market rents of the property in an as-is condition. But on top of that, they can also look at the financials and the rent roll of existing properties being used. And so in particular, in a short-term rental, looking at the financials should show stronger income and maybe used to be allow you to get up to 75% financing on a refinance after you have a couple of years of taxes reported with this showing strong income. Here's another more interesting method that we've been using a fair bit within the small business and commercial lending framework, and that's called the corporate guarantee. And so corporate net income can be used to boost the qualifications as well. So sometimes we'll find that a borrower has a really strong company, and we can do a cross guarantee where we can say, okay, use your operating company to guarantee this loan on this property because the property itself doesn't have strong enough income yet. But if your company does, then you can use that to guarantee the debt. Once the property's up and running and has a good, strong track record, then you can apply to have the corporate guarantee removed. And so this is one of the things that a lot of people don't realize, and this is one of the really cool things that you can do with finance in the small business and commercial world, is it's just like parents co-signing for their kids to buy their first home. The kids can't quite qualify on their own based on their income, but with the parents' income, the numbers work, and therefore the lender will lend out the money because they have enough strength with all of the guarantees. A corporate guarantee is like the same thing. It's like the parent co-signing for the kids, where they say, hey, you know what? I'm not taking home enough money in order to debt service this, and the property isn't debt servicing on its own, but we can add another company in that provides the guarantee that will get the numbers up to where they need to be. And so this is one of those ways that we've been able to do it. And just by slapping on that guarantee, all of a sudden you're finding that, hey, now you can get up to 75% leverage on these assets. Some of these even up to 80%, depending on the lender that you're dealing with and where the property is located. So there's a lot of different differences here between commercial, small business, and residential. And so if I go across the board here and look at the qualifications, commercial is based mostly on the property, small business is a bit of a hybrid, and the residential is based mostly on the borrower. Commercial interest rates are typically higher than residential. However, if you're not doing a short-term rental type of property, and you're going with what's called a CMHC insured multifamily building. So if it's a 5+ unit, and if you're doing a long-term tenancy, then actually the interest rates for commercial can be cheaper than residential. Small business is typically a little bit more expensive than residential. Residential is usually the cheapest. Residential interest rates have risen for sure in the last little bit. Depending on whether you're going variable or fixed, et cetera, the rates have gone up. In fact, 5-year fixed rates today for residential are up to about 3.99% in many cases, which is quite shocking actually to see them go up that high that quickly. On financing amount, the loan to value, commercial properties, because it's based on the property, we've had some deals where the property only qualifies for a loan that's 16% of the value of the asset, which is absolutely crazy. So this is very tied to the financial strength of the asset itself. In general, commercial will go up to 75% financing. However, if you're buying a multifamily building, you can get up to 85% through CMHC, although it is very difficult. If you're buying an owner-occupied space like a warehouse for yourself, you can actually get up to 100% financing for those types of acquisitions. And so that's a really cool thing that is important to note too. And these aren't relative and relevant for short-term rentals, but basically what I'm saying is commercial, because it's based more on the cash flow of the business, there is some more flexibility with it. Small business will be restricted to typically up to 80% of the property value. Most small business lenders, however, are 75%. Residential, however, as of now, still goes up to 80%. We are hearing some talk, however, the government might step in and start to actually increase down payments on residential rental properties. And so we might see that this down payment starts to increase a little bit. I'm not so sure if that's absolutely happening yet. I think they might just wait and see what impact rising interest rates has on the real estate market first, but it'll be interesting to see what happens regardless of that. Lender fees. Commercial is usually 1/4 point to 1%. Small business is usually 0 to 0.5%. And most of the time on residential, you're not paying a lender fee. With broker fees and commercial, it's usually 1 to 2% of the loan amount. Small business, same thing, 1 to 2% of the loan amount. And residential, normally there's no broker fee, but sometimes there can be a broker fee of around 1%. Appraisals, legal fees, extra fees. Commercial is usually more expensive, anywhere from 5 to 15 grand. And generally, small business and residential, usually a bit smaller on that. Small business can be a little bit more expensive, but is often much closer to residential than it is commercial. And then company name, commercial and small business, definitely in commercial and company names. In fact, they often prefer it. Residential, often a lot more difficult. There are still lenders that are doing these in company names, but it's a lot more difficult. One thing to note is that some people try to hold their short-term rentals in operating company names because of the difference in tax. You need to make sure that A, you're talking to your accountant about that, but B, it is a lot more difficult if you're trying to get residential financing and putting it in an operating company name. That's typically a no-no, where in commercial and small business, they're more willing to consider and accommodate that. So we've had a couple of lessons with running our Airbnbs, and one of the things that we found very, very quickly was that the design is really, really important with these types of properties. Automation is another thing that's really important, especially with check-in, checkouts, et cetera, and communication. And so we want to make sure that the communication is really, really good with our guests. And so with the design, we found the design really sells the unit. We're able to get a lot more rental income back if the design looks really good. And I see a lot of short-term rentals that people just leave the furniture that they've had in their unit for years, and they just slap it onto the up on Airbnb or VRBO or whatnot. But there is a good return on investment to put the right types of furniture and the right design into the unit. And the other thing you need to keep in mind is that durability also matters. When you have lots of in and outs and people that aren't living there long term, they're not necessarily going to take care of the furniture really well. And so there is a fine balance between the right design, but still something that's durable. And so you have to make sure that you're trying to think of both aspects when you're trying to figure out how to furnish your short-term rental. The automation factor, keyless entry is really, really simple and easy to set up nowadays. There are even programs where you can set it up so as soon as somebody checks in using one of the short-term rental platforms, it automatically sends the guest a 4- or 6-digit key, and they can use that key to get access to the unit. And so keyless entry is something that's becoming a lot more popular. And PMS, which is property management systems, there's a lot of property management software out there that allow you to create a lot of automation. You can set it up so that as soon as the guest confirms the booking, an email goes out to them or a text goes out to them. You can set it up so that 5 days before their check-in, a text or an email goes out to them. 2 days later, another text or email goes to them. The day of, another text or email goes to them. You can set it up so that different messages are going to your guests. Now, in general, if you're just managing one unit, it probably doesn't make a lot of sense to create all this automation. But if you're planning on doing this as a business, then it can make a lot of sense to set up a lot more automation and whatnot, because you're going to get the benefits of having this all automated on a larger scale. And with regards to communication, very important to have speedy replies. In fact, the short-term platforms do monitor this, and they look at what your speed of response is. The faster your speed of response, guess what? You're going to be put up to the top of the list. You're going to be more likely to be given a special treatment from these platforms if you're quick to reply to guests. That's a really important feature. And customer service is really important too. You have to have good customer service. You are in the hospitality business, and I can't stress this enough that it is not the same as just having a long-term tenant in your property. So the the reason that that we got into short-term rentals in the first place was this property. So I actually had two pre-sales in Langley, and they both closed April 30th, 2020, right in the height of COVID. And so decided that that I was going to offload one of them and keep one of them. Didn't know what was going to happen with the business, et cetera. And so wanted to make sure that I had some cash available for the business, and then closed on the other unit, and we decided to Airbnb it. And so what we decided to do was decided to furnish it and look at some of the key features in Langley. So there's the Fraser River. We also looked up what else is in the area, and in that market. There's a horse course. It's the Thunderbird Stadium, where there's a lot of horse events there, and so we decided that we would put up a large horse photo. In fact, we get a lot of guests inquiring how close we are to the Thunderbird Stadium, and a lot of the guests that stay in our unit are staying there because of these events. And so what we actually do is then we look up when the Thunderbird Stadium events are coming up, and then we put up our prices during those time periods, and we make sure that we're managing and watching the prices all the time to make sure that we're capturing that increase in the demand for those little pockets of time. And so we found that the design really makes a difference. There's a couple of other owners who run short-term rentals in the same building as us, and most of those people are getting $99 to $119 a night. Our unit gets about $150 to $170 a night. And so we get a lot more rental income on this particular unit. Christina thinks that we spent about $10,000 on the furnishings. I think it might have been closer to 15,000, but regardless, we actually looked at our numbers just the other day, and our average rent for this place that we paid $400,000 for was $3,700 per month last year. And in addition to that, to make the management easier, we discount weekly stays by 10% and discount monthly stays by 20%, because for us, taking that management requirement off of our plates, we don't have to consistently do check-in and check-outs. We prefer to take a little bit of money off the top, get better longer-term stays, people that are staying there for an extended period of time, and one way or another, we're getting nearly double what we'd be getting if we rented this out on a long-term basis. So it makes a really big difference. So after doing that, another opportunity came up, and we bought a building in Victoria, downtown Victoria, and it's a 7-unit building that we purchased. One of the units is ground floor, and it's a live-work unit, but the other 6 are short-term or Airbnbs. And we decided to theme each of the units. And so we have units that are themed for Chinatown, for instance. We have a number of different themes like Parliament, Indigenous, Navy, Garden Room, Orca Pad. And we basically set it up so that each of these units is very unique and has a real strong design flair. So you can see the top there, that was what the unit looked like when we first bought it. And then the other 2 photos are now what the unit looks like now that we've renovated the unit. So we're really trying to apply a strong design flair on this, and we found that we're getting a lot more rental income for the property because of that. This is what our Orca Pad looks like, for instance. So a lot of black white features, and then just pictures of orcas throughout. And so far, this has been one of our best performing units because it has a nice modern design with it, but also attracting people to why they might be visiting the West Coast in the first place. A lot of people are very interested in orca whales, and so having a unit that's kind of designed around that theme has been really attractive and lucrative. And so yeah, lots of different things that we've done with the design, and our reviews are really strong. For instance, this one's a 4.9 with 22 reviews. We really tried to make sure that we kept really good reviews. And so one of the strategies here is, in the very beginning, what you want to do is you want to keep the income and keep the nightly rates low to generate lots of positive reviews in the very beginning, because it's hard to charge a premium rate until you have proof of concept, aka strong reviews. But as the reviews start to go up and the vacancy starts to shrink, you can start to demand higher prices. And so imagine yourself as a potential guest on let's say Airbnb platform, and you're looking to book this, like, oh, that's really nice. Like, oh my gosh, it's so expensive though. And then you start to look at, well, look at the reviews, it's 4.91, and look, they're fully booked, or they're pretty much booked. You're going to start to feel like, oh my, I guess the price is justified here, right? But it's much harder if you have tons of vacancy and availability, and you have 1 review or 2 reviews. So it's important for you in the beginning. Don't set your price at where you want it to be. You have to have a ramp up period to start to have proof of concept, because then you start to get the momentum. And then once you're at that price point, because you have low vacancy and you're hitting the prices, then you can keep rolling with it, and you can continually increase your prices moving forward. This is just a photo of our garden room, for instance. One thing that I want to point out here is the photography is another important piece of the puzzle too. You'll notice that this photography is a little bit different and unique. I can't remember the name of the show, but we watched a show on, I think it was Netflix, and I think it was called, it may have been called Stay Here or something like that. But one of the observations we had is they flew in, I'm probably a little bit extravagant, but they flew in with their photographer. The photographer would take photos of you know, a little teacup on a table, and it's not really showing what you're getting, but it's showing the design and the care that you put into the design. And we've taken a lot of what we learned from watching that show into designing our units. And so, for instance, you can see the photo of the flowers, the flower vase, and then the blurred out wallpaper behind it. Those are the types of things that we kind of took from that show and tried to make sure that the design flair was really featured prominently in our photos. And this one, you can see that we have 9 reviews in there as a 5-star unit. Like we've across the board, it's 5 O's. Now, in addition to that, it's kind of interesting this happens, but after doing the Victoria deal, 2 of my staff members just tied up a property in Abbotsford, and they've asked me to look into the deal and run proof of concept. And so they're actually raising some money now to do that deal. And this is a completely different deal. It's more of like a wedding venue type of deal, but it's very similar. Actually, when I looked at it, the analysis was very similar to running a short-term rental, where it's a different business model, but the cash-on-cash return for doing these unique deals is very strong. And so, if you did want more information about that, I'm happy to pass over the package that my 2 staff members that tied up this property have looked at. So, if you want, you can email us, and happy to pass and connect you together to the individuals that were doing that. So overall, I think there's a lot of different things that we look at with regards to how to set these things up. How do you structure these deals? The financing is very unique and different. And again, there's a lot of elements here where you're really running a business, and it's not just a long-term tenancy. And so we do have some tools. One of the things that I did is I had a cash flow analysis spreadsheet that I built years and years ago for myself, and actually modify that spreadsheet to add in a short-term rental flair to it. And so if you ever wanted to run that and have something that kind of looks at low, mid, and high seasons, and you can toggle the vacancies in the low, mid, and high seasons, and look at different rental incomes and whatnot, that's something that we found is very valuable. I do have a commercial analysis tool as well, so you can run the numbers and see, well, how much financing could I get based off of the income if this was done as a short-term rental and I wanted to refinance in a couple of years with a bank on the commercial side or small business side. We have our investor kit and also monthly webinars. Another tool that I didn't go into a lot of detail on, there's a couple of different options here, but if you're looking at buying in a specific market, there are also products like AirDNA where you can actually go in there, pay for a subscription to a specific market. And this is what we did for the Victoria deal. We got a ton of macro data on what the vacancy rates are, average daily rents are. You can look at 1 bedrooms, 2 bedrooms, bachelors, etc. You can run really good analysis and numbers, and you can track it, and it helps you with ongoing pricing if that's what you're doing, but you also can use that to determine and run numbers on an analysis on a potential acquisition as well. So this is just a quick look at one of our spreadsheets that we have. And so if you did want to investigate how you can finance these, every deal is different, especially short-term rentals. There's a lot of little nuances. It's not like buying a standard condo in a downtown market. Those are pretty cookie cutter, and you don't usually have property challenges or issues with those. But when you're dealing with short-term rentals, it can be a lot more difficult to finance. And so if you did have something that you're trying to get financing on, it's important to book a consult with us so you can explore that and figure out what you can do. If you want to learn more, there's always upcoming webinars Actually, my next upcoming one is not the vacation rentals one. It's actually coming up the first Wednesday of every month. And the next one that I'm doing is looking at pulling out equity out of your residence to invest, and how you can do that, and how you can create a spread on what your cost of borrowing is versus what your investment returns are by borrowing against your residence. And one thing I'll note is that with where the market is at, we might be getting closer to that peak in valuations. Now might be the best time to be able to access capital in your property. I did write a book called Rockstar Real Estate Investing. I did not actually get into short-term rentals in that book. It was published a couple of years ago, and at the time, these were just a bit of an up-and-coming feature, and so this is not included in my book. But if you would like a copy of the book, I purchased a number of copies and have them at the office, and so I'm happy to just send over a copy if you send an email over to us at info@greenmortgageteam.ca. And put in your mailing address, then we'd be happy to send you over a copy of the book so you can read it and maybe get some tips. And in general, the book was designed mostly for helping newer investors start to grow and build their portfolio, and teach people the fundamentals on how to invest in real estate. So that concludes the information in my presentation. So what I'll do now is I'll start to go to the chat and answer some questions. And in the meantime, please make sure that you go to the Q&A and put in any questions that you have, and I'll start to answer these. So Ali asks, do you usually buy in apartment buildings or single family? How Strata is looking at this if it's in an apartment building? So good question, Ali. In general, buying a Strata unit property is exposing you to a lot more risk, because even if the Strata currently may allow for it, it may not allow for it in the near future. And so in general, most people are avoiding Strata properties unless it's a property where it's obvious that the ownership and the Strata bylaws, et cetera, are allowing them and are likely to continue to allow them in the future. So I do find that most of these short-term rentals are less risky if it's a detached property, because you control more of the income. I have another question. Does it have to be your principal residence in Victoria and Abbotsford? I think the question is referencing, like, how would you set up the financing for these types of properties? No, when we bought the property in Victoria, it was not considered our residence. It was considered we looked at doing it as a rental property with lenders, and that's actually a very complex structure that we ended up doing. So we learned a lot going through that process, even as a mortgage broker financing, 480 clients last year. And actually the top 75 for mortgage brokers in Canada just came out today, and Green Mortgage is number 14 in Canada for funded volume last year. But even then, doing your own deal and a complicated structure that took months to finalize was insightful, because there were some nuances and hoops that we had to jump through in order to get all 7 units financed at good terms. So no, those units, and we did not classify as residences or second homes to get financing on them. What city do you recommend for Airbnb investment in British Columbia? Good question. Victoria is a good one. I do like Victoria for sure. Other markets that are interesting would be Tofino, Ucluelet, those types of markets where there's a lot of people that travel. But I will say that the prices are very steep. You'd be surprised, a not super fancy home in Tofino, not even on the beach, but near the beach, will run you like $3 million, which is quite surprising. So I don't know how great the opportunities are. I do think that you're going to find certain smaller markets, like perhaps 100 Mile House, which is a little further away, might see a bit of a spike in short-term rentals coming up in the next couple of years. I've heard this, and I do believe it, because when I'm looking at traveling somewhere, it's a kind of a metric that I look at too. But I feel like people are willing to drive about 4 to 5 hours from Vancouver, maybe. But as soon as you start to get past 4 or 5 hours, you're going to see a fairly steep drop off in the number of people that are willing to commit to that kind of drive. And so I do think that if you're trying to buy something in a smaller market, where the drive is no more than 4 or 5 hours away, then that's a good opportunity. But in general, lots of places on the island are good opportunities. One consideration is you might need to or want to stay away from the Gulf Islands. And so all those little small islands in between Vancouver Island and Vancouver and the mainland, those Gulf Islands are I don't want to say managed by the Island Trust, but they're overseen by something called the Island Trust. And the Island Trust, I can't remember if they did come out with this or if there's been strong talks about it. But essentially, if it's not already a rule, then it's likely to become a rule. They're only allowing you to short-term rent your property if you're living in the main unit. And so basically, they're trying to deter out-of-town investors from buying a property and then using it as a short-term rental. But they're trying to allow for people that already have a secondary dwelling on their own personal residence where they live to do short-term rentals on it. And so the Gulf Islands is an area that I would actually actively avoid. Initially, before we bought the place in Victoria, that was our first place we were looking at because we really liked the Gulf Islands. And then we realized that and we started to really back off because we felt that that was very risky. Other areas that are good to look at would be the Sunshine Coast, so Seashelt, Gibsons, Half Moon Bay, and going up that the Sunshine Coast is a really good opportunity as well. We think there's some untapped potential there, and of course just going east. Penticton, Kelowna, et cetera. Those are strong markets. It's just that the prices do start to get up there in Penticton and Kelowna. So you might need to go further away. And I think an area of opportunity might actually be to start going north, going to areas like Pemberton. So instead of going along the Coquihalla, for instance, going east, it might be making sense to go north, going up to Lytton, Pemberton. Some of those areas might be a little bit untapped. Ryan has a question. If you have a property manager for your short-term rental, can you refinance to pull money out? Still quite difficult to do this even with a property manager. Yes, you now have some statements showing that you're receiving an income. The only thing that I've seen that has made this a bit easier is if somebody is leasing the property from you and you're getting $2,000 a month, and $2,000 a month shows up in your bank account every single month, and then whatever they may be doing with the property is up to them and their prerogative. But as long as you have a consistent lease agreement where you are always getting the same amount of rental income, then that might be something that could work. However, you're still going to have some issues or risk where the lender will send an appraiser out to the property, they take some photos, and right away they walk into the home and it says, welcome, and it says the Wi-Fi password is this. Going to be pretty hard for you to say, oh, no, that's just a long-term tenant that lives there, and he just always forgets the Wi-Fi password. So pretty difficult to sell that. And so you may be avoiding the income problem with that, Ryan, but you may not still be avoiding the whole, does it look like if it looks like an Airbnb and quacks like an Airbnb, then it's probably an Airbnb. Another question here. Thanks for recommending the cities. Do these cities have any regulations on how many days you can Airbnb it out? Does it have to be a principal residence like the city of Vancouver requests? To be frank, that comes down to local municipalities. So one of the things that we noticed is in Victoria, for instance, the property that we bought is in a zone where the zoning allows for short-term rentals, and we have an email from the city that confirms as such that we then saved and filed away in our due diligence. And that way, if we ever have any problems with the city later, we can pull up that email and say, hey, look, you sent us this email. We made a large buying decision based off of this information, and you can't change your mind later on. So that was one of the things that we found was important to de-risk ourselves from that investment. On the flip side, I don't actually know some of those other smaller markets and communities and how they view it. I mean, Tofino, Euclid, for instance, there's a lot of short-term rentals on those markets, and I don't really see them changing the guidelines or laws, but it is something that you definitely need to be very aware of. There may be some way of working around it. Maybe if you stick a long-term tenant in the property that then you use for renting out maybe to manage your property, et cetera, then that could be another option too. So that's something that you might want to look into, but I can't comment specifically on some of these other smaller markets, as you would want to do your due diligence and look into that. Awesome. I'll go to the, I see some chatter in the chat, so I'll take a look at it and see if there's any comments that I didn't notice here. I had a question from Malvina about what about a rental property in Kelowna? Can the lender lend based on market rental value? So in some cases, yes, you can get a lender to consider the market rents on a property, especially if it's a regular residential property. So, but again, it's very case by case. If it's a property in Kelowna that is a cabin in the middle of nowhere, then it's a lot harder to get them to use market rents. And another question from Kelly here is small business or commercial lending. What if you're hiring a short-term property manager? So it's same thing that I answered earlier. It doesn't necessarily solve the problem. It may give you a bit more stability with regards to the income, but you probably would need a separate individual to be actually leasing out your property on a long-term basis, and then perhaps subleasing it out. That might solve the income problem. Michael asks, what determines the commercial approach versus residential? Is it specifically aligned to the zoning designation as such, or something else? I.e., can a residentially zoned property get a commercial loan? The answer is yes. And so you can get this, and sometimes this means that you have to fall into the small business classification, or sometimes they'll still look at commercial. One of the things you'll find is you cannot, or it's very, very difficult, get residential financing on commercially zoned property. However, you can get commercial or small business lending on residentially zoned property as long as it is a business in some way, shape, or form. So it's owned by a company, and or it is an operating company of sorts. You can also get small business lending or even commercial lending for a regular residential property that is in a holding company, for instance, because even then it's still considered business lending, but often the lenders usually try to push that into the small business side. Sometimes you do find, however, if it's a regular residential property and it's a small mortgage and it's in a company name, it may fall into a bit of a dead zone with some of the lenders, because they might say, well, it's in a company name, it's a bit small, it doesn't quite fit the commercial book or the small business book. So some properties do fall into a bit of a black hole in some of these cases, especially with many banks having a minimum of $1 million for commercial lending. But overall, to answer your question, yes, you can get commercial or small business lending in general on residential lending. And so the classification comes down usually to, is it a business, AKA, is it in a company name? Is it earning an income in that situation? And even a long-term tenant could still be classified under a small business or commercial loan. Kelly asks, do the bylaws in Victoria support having the units as short term? I'm interested in a commercial property like this, but we're nervous to take the risk if it could be shut down. So yeah, in our exploration, it appears as though about 18 buildings in Victoria have the classification necessary to be operated as a short-term rental. And so you have to be very careful about the bylaws, because yes, that's a lot of exposure if you buy a property and then get shut down because the city doesn't want to allow short-term rentals in that building. So definitely something to keep in mind. Sandy asks, if you change the use of a basement suite to short-term rental from long-term, does the current lender require notification? That's an interesting point. I don't think I've ever had a client that has gone out of the way to inform the lender. You'd have to read the full disclosure, which is a very long, drawn-out document that the banks say, and there's a lot of CYA, cover your butt, items that are located in that long document. In general, I would say that the lenders, for the most part, don't really care, but it is something that, from a legal perspective, to give you legal advice, I'd have to, we'd have to go through that document in length, and you'd probably want to talk to your lawyer about it. But the reality is, the lenders generally really don't care as long as you're making your payments on time, and so it's unlikely that they would ever have an issue with it. Max has a question. Hey, Kyle, was the zoning already in place for your Waddington rental? Yes, it was. And so that was easy. We didn't have to rezone it or anything like that. Arash has a question. What would be considered a good ROI for short-term rental investments when you're assessing an opportunity? That's a really good question. So it kind of depends. I would say that the ROI is coming from 3 different spots. It's coming from the cash flow, mortgage paydown, and from the appreciation. And so one of the considerations here is that, you could use a simple cash flow analysis spreadsheet to kind of look at this, but if you were to rent it out and use a property manager who's going to handle all the short-term turnarounds, they usually charge anywhere from 20 to up to 30% of the gross rent to do that. And so my feeling and thought is, if you're trying to compare apples to apples and you look at, okay, if I bought a regular long-term rental property versus a short-term property, but you wanted them to be compared, apples to apple comparison, Then I would look at, okay, if I bought a long-term property, I don't have to do much property management. So how much would my cost be there? And still property management to just do the long-term turnarounds would be maybe 8 to 10%, but probably closer to 10% of the gross rents. Then I would look at bumping up the income based on what you think you can get for the property, and make sure you have some vacancy included in there too, especially if it's seasonal. And then I would look at bumping up the property management up from about 10% up to about 25 or 30%, and then see what the income looks like from that perspective. If it's about the same, then I would probably say, you know what, it's probably worth it just to do a long-term rental property, because you're not taking on any additional risk or any other other concerns or issues. If the income is much better, however, on the short-term rental, even with the larger property management cost, then I think that's a good indicator that you might have a good deal in your hands. But just keep in mind, it is a lot of work to run these short-term rentals. It's not simple, and it does require a lot of work, setup, and management. Awesome. I've got another question in the Q&A here. So Adele asks, do you have to set up a company to run an Airbnb business? The answer is no. You do not need to, but there may be tax advantages to doing so. And so that's something we need to talk to a lawyer or an accountant. If you do want to get small business lending or commercial lending, then in general, they do prefer you to be doing this in a company name. And so it's much easier for you to get financing if you structure it that way. And so it does depend on the different strategy or game plan that you're looking at for that. Thanks, Adele. Awesome. Any other questions before we wrap up the presentation? I think I've answered all of the Q&A so far. Any other questions? You guys are taking it easy on me. Awesome. So I think this covers everything. If anyone has any questions or needs some clarification, feel free to email us at info@greenmortgageteam.ca. Happy to just send you some more information about this. There's some tools, we have books. We're here to help. 80% of our clients are real estate investors, and this is something that we've really focused and spent a lot of time learning about. And from a personal level, I've also spent a lot of time learning about and getting better at too in the last 6 months since we bought our deal in Victoria. Adele asks, when am I back on the Vancouver Real Estate Podcast? Depends on when the Scalenas invite me back. I'm sure they'll be inviting me soon. We always have a really good time on the podcast, so I'm sure I'll be back in the next couple of months, I'm sure. Awesome. Well, thanks so much, everyone. Thanks for attending, and I look forward to seeing you next month, the first Wednesday of every month. Thanks. Bye.